So we're up to class 10. So I want to spend quite some time on paper one. We might do this again on Wednesday, but I had 3 people offer their papers up. And the first person who sent it, he actually didn't offer his paper up, but it was really good paper. So I said, hey, can I show your paper to the class? So we'll start with his. I'm going to use, I'm just going to grade his paper like I would normally grade it. All right. So you can just watch me grade it. I'm going to see if he got the jobs number correct. That's like a gimme point. He's going to talk about expectations. That may be a little different depending on your source, but I'm hoping you're all using the same source because I gave you a source. Make sure y'all are on mute, whoever's on there. Song, are you on mute? Someone else is there, I can't. All right. So what about the prior number and revise? One person sent their paper and they got somewhat confused on those. So make sure you know the prior number was what, revised from 199 to something. I can't remember what, but pretty dramatic. Should talk about private jobs. That's always important. The rate, the expected, the prior, there's no prior revised on the unemployment rate because they don't revise that number. Participation rates are very, very important. And then there's other things on sectors, on wages, on hours. You don't have to do all of them, but I'm looking to see if you got the ones that are important. Did you do anything else? ISM, the jobless claims, ADP, there's a lot of other things out there that you could have done that would be important. And then a big part of the paper is the market reaction. How did the stock market react? How did the bond market react? And then what about other markets? All right. So we'll look at that. So I'm gonna actually grade it while I'm grading. I usually grade it on the computer. I usually have your paper on one computer and I've got this on another computer, and I'll give you this back with all your details. So if you're like, no, I didn't get that wrong, then you can come debate with me. The last part is clarity and critical thinking. The clarity is it well written? Does it look professional? To me, I just look at it and say, would I hire this person just looking at it? You know, how professional is it? Does the person take pride in their work? Or are they just gonna throw something together and it looks like a college student wrote it? You know, and in critical thinking is, are they covering the right kinds of things? Are they asking the right kind of questions, making the right kind of comments? You know, the critical thinking of, do they sound like a finance person? Really, the way I read it is if I were a person doing my job and this is what someone submitted to me to help me do my job, did they actually help me or did they waste my time with a lot of superfluous information? All right. So, all right. So I'm going to look through it. I made it anonymous. He may not have wanted it anonymous because it really is a really good paper, but I made it anonymous. As far as the format, I like the format. You want to make it as much look like a journal as possible. I might, if I were he, you might experiment with like centering this and just seeing if it looks better centered or not. What do y'all think? Centered or left or full? What's the vote? You like it better centered? I mean, full can be nice as well, but the problem with full is that last line kind of looks by itself. So that works. Thin margins, that's good. You want thin margins. You can use 2 columns. So you don't want a one, you know, what's really bad if a 1-inch margin and you're using 2 columns, everything just looks all squished. Why? Because you have more margin here, right? In the middle. So if you're using 1/2 inch, then you have 1/2 inch on the sides and you have 1/2 inch on both sides. So, you know, you got your inch. If I were he, I would probably go full justify, but you don't have to. I just like full justify because it really does look like a journal, but that's your choice. I don't can't offer that. I'm looking more if they were to put it into a paper. He's got a quote. How does that look? Looks really professional, doesn't it? Italicized, centered. That's what you want. So, you know, it looks good. What I'm going to grade on the quote is the quote of any value to me? Some students quote like, the federal government reported 467,000 jobs last month, and that's their quote. It's like, you don't need to quote that. I mean, that's the number, you know, quote something that does what? Gives some insight. Why are you quoting? Some expert, right? Someone who knows what they're talking about. So don't quote your next door neighbor. My next door neighbor, Bob, he's a taxi driver and he thinks these numbers are really bad. That's probably not going to help much. But if you quote someone who's like Bill Gross or someone that's in the market, I listened to a lady today, Samantha, and boy, I cannot remember her last name. There's a podcast. She works with Bill Miller. A lot of really great insights. There was times I wanted to stop my bike and write down what she said because I thought, wow, that's a really good quote. I could really use that. Someone who knows what they're doing, she's managing billions of dollars, has really good returns. When she says something, it's interesting to me, and so that gives some insight. But all she says is, markets look interesting. I don't know if that tells me much, but she says something that's really, really good. Good use of titles. He made it, I mean, it looks very professional, right? All the way throughout, good use of graphs. I like the fact that this graph, not only does it look good, but the title tells you what the graph is showing you. That's always good. You want the person to read the title of the graph and say, oh, this is what you're showing. You don't want the title of the graph to be what the number are. So participation rate. Okay, participation rate, what about it? Did it go up? Did it come down? Recovering participation rate, well, that tells you something. The title tells you what you're looking for. Is that labor market participation recovering from pandemic low? You say, oh, I see what you're telling me. Otherwise, what does your boss have to do? Participation rate. Okay, well, okay, then it dropped. They're trying to figure out why you put the chart in there. If you can tell them in the chart title, now, I don't know if he created his chart title or if he got it out of a newspaper, but either way is fine. Here, you can give your sources. That's a perfectly good way to do it. I'm not real picky about a bibliography that's in detail. One thing I am picky about, well, two things. I had a boss that was real picky on the first one, which is the date. Make sure you always put the date. If you're quoting someone, and on this paper, it may be obvious that you're quoting them on the day the report came out. If that's obvious, that's fine. But if it's not obvious, put some date on it. I had a boss that if I didn't put the date of some kind of quote or data, he was like, this could be 20 years old. Why are you showing me this? I don't, tell me where you got it from. So yeah, so the critical thinking, the clarity part is probably gonna be good. I'm gonna actually read what he writes and see if it's clearly written, but he's gonna get good marks for just looking professional. So what do y'all think? Full justify or left? Like an eye doctor 1 or 2? You like it left? All right, some people do like it better left. I like it full, but it's up to you. All right, so let's see what he actually says. With the recent increase in cases of COVID, many investors and analysts awaited the recent release of the employment. Leading up to the report, the assumption was employers would curtail hiring due to COVID. However, jobs posted surprising gains. Shocking comment of blame made consensus estimates. That's a really good lead in, isn't it? I hope I don't see that in anybody else's paper, but that was really good, right? Clear, is it clearly written? Anybody confused what he's saying? It's well written. Non-farm payrolls led the way with 467,000 new jobs created compared to 150 that was expected. Did he give me the number of jobs added? So 100% on that, right? Did he tell me what was expected? Yeah. Is he gonna give me the range? Here's a place where he might give the range. We'll see if he gives the range or not, but I think the range might be important here. Why would the range be important here? Because we're way outside the range, aren't we? The range was 400 to 280. We're at 467. So you might mention the range. Let's see. I don't know if he does or not, but you might do it. The biggest gains we're seeing in leisure and hospitality. They didn't give you that number, right? They gave you manufacturing. So he had to go somewhere and find that number. Do you think giving the biggest number might be important to your boss? Coming out of COVID, does the fact that leisure and hospitality is adding a lot of people sounds pretty important, doesn't it? What is everybody saying? Prices are up because services are still shut down because of COVID and people are buying too many bicycles and cars. Well, if leisure and hospitality is up, that means people must be coming back and doing services. And professional business services added 86, even with the increased leisure and hospitality industry still well below pre-COVID. That's a nice little add. Along with the huge bumps in payroll, we also saw an increase in wages and hourly earnings. 0.7%, slightly beating estimate 0.5. At an annual basis, hourly is up year to date 5.7 versus trending. So he got some points there for talking about wages, which is, I think, pretty important in this report. Don't see everybody's talking about inflation. Wages is probably pretty important. So he's doing pretty well. In addition, BLS also reflected drive increases in the previous 2 months, with November seeing a previous reported 249,000 jobs jump to 647, and December's 199 to 510. Then he put the whole thing in there. Now, if you put this chart in here, don't give me the numbers. I'll give you some credit for giving me the numbers, but I'm not a big fan of, hey boss, I'll put a table in there, you can figure it out yourself. I don't like that. Give me some commentary. All right. If the key was just go get the numbers, then your boss could have done that themselves, right? They don't need you to do that for them. So he definitely talked about the prior revised. The revisions took the 2021 job total to 6.66 million, making it the largest gain in a single year in U.S. history. That's pretty interesting. I didn't know that. Kathy Jones at Schwab stated the following when addressing recent revision. Let's see if this is a good quote. The benchmark revisions helped the numbers a bit just because it moved out of some of the seasonal factors that have been at work, but overall the job market is strong, particularly in the face of Omicron. And that's good. There's some good stuff there. It's hard to find great quotes sometimes. So sometimes you're kind of like, I found a quote, kind of works. And I'm not even sure she actually even said that. I think I told y'all when these, I used to get interviewed by, oh man, I don't remember who it was, just Business Week or all these firms. And they didn't actually interview me. They called me and asked me if I thought something. If I did, that was their quote. If I didn't, they called somebody else. So they already had the article written. They just had to put in the name of who said it, which is kind of crazy, right? Because you have journalists that have very little finance background calling finance professionals, already have their story written. Say, Ron, do you think inflation is still going to be a concern next few months? Yeah, I guess I believe that. Okay, Ron Sweet said inflation. It's like, okay, you don't really care what I think. So who knows if she actually said that, but it tells you gives you some insight. The unemployment rate captured the percentage of total workforce yet actively seeking. Despite this essential growth, the unemployment situation rate announced an increase in unemployment rate to 4%, outpacing the 3.9 consensus. So he's got those two. Actual versus expected. For many, witnessing a rise in jobs, some economists attributed. What are you not seeing in this one? You got the current rate, you got expectations. I'm not seeing prior. Do y'all see prior? So make sure you get prior in there. Okay, so I don't see prior. You can get the prior. I can't remember what January was. Did it tick up a little bit? 3.9. So you could get credit by saying outpacing the consensus that the rate would stay the same as the previous month at 3.9. You could do that, where it's obvious that was, the consensus was it would stay the same as the prior. So you get credit if you do that. All right, so that's the only thing I haven't seen. He's probably got it in here somewhere, and I just haven't gotten to it. He talks about the participation rate. The number is divided by total institution. Participation rate steeply dropping in the beginning of the pandemic to low as 60, but then there has been a slow rise. However, participation has not reached pre-pandemic, and he's got that good chart there. In January, jobs participation increased to 62.6 compared to 61.8, the highest has been since March. Here's a quote from a professor of economics. People are being both encouraged and forced back in looking for work. My interpretation of the evidence suggests that those who quit and held off getting back are now finding job opportunities are too valuable to pass up. While might maybe be forced, if unemployment benefits are going away or other, some of the pandemics, government payout is going away. If that's the case, maybe they're being forced back. They just have to. So that's a good quote. I like that. I don't know who this professor is. There are multiple employer-driven factors that have helped spur the recent increase. For one, wages have continued to rise rapidly. Oh my word, he's got a better vocabulary than I do. What does that mean? I don't even know what that word is. So what is that word? Can someone say that word? Simultaneously? All right, I had to look that word up. All right. Simultaneously, employers are increasing flexibility in scheduling and work life. The Bureau of Labor Statistics reported an increase of 15.4% of the workforce working remotely. All right. An increase in labor participation. We give them credit for labor participation. is welcome sight for the economy, especially when considering the amount of attention on job jolts. So he's going to talk about the jolts. So that's a good thing. I think the jolts is a pretty big thing. The quit level, nearly 4 million Americans on average quit their job each month last year. That's, yeah, I mean, I guess that's a quote where he's just giving data. So it's okay, but you know, he might do the quote, but just not italicize it and stuff. I don't know. It's just, to me, it's just telling me something that, you know, it's just data, but I'd like the quotes to say some insight into the data, but it's okay. I don't count off for it. The elevated quit rate led to period being marked the great resignation. Here he shows the quit rate all workers. He didn't put a title on this one that kind of tells you why it's there, but it's probably because the source didn't have that. The January quit rate increased to 3.7%. Aside from quits, JOLTS also surveys how many workers were hired, laid off, and other separations. JOLTS also reflect higher rates are greater than quits in all sectors, with sectors that historically pay lower wages experiencing higher levels of both quits and hires. Higher rate, quit rates. This chart's a little challenging in that I'm gonna have to sit and stare at it a while to figure it out. So, you know, try if you can add yeah, maybe I'm just not smart enough to, you know, and figure out, well, 50 people are staring at me. It looks really interesting to me. So if I had time, I'm later and go back and look at that more. It looks interesting. The hiring quit rates, both are, he's got a typo on there, both are at raised volumes. Economists believe workers have more, sorry, I misread it. With higher and quit rates, both at raised volumes, economists believe workers have more options. The job has become a commodity. That's a good short quote. If you don't like this one, you can get another one. That's a great quote. I like that one. He talks about ISM. One thing on ISM, if you're going to do ISM, even JOLTS, have some kind of setup that your boss didn't ask for the ISM, your boss didn't ask for the JOLTS, something along the line to put this report in the context, in the bigger context, something like that. All right. Otherwise, your boss is thinking ahead and asking about the ISM. Well, I just wanted to give you a bigger context to the reports. You know, give a bigger context of the report, the ISM that came out a couple of days earlier, blah, 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 kind of thing. All right. But definitely ISM. The survey measures change. Now, that's a lot of data. If you're going to show something like that, I like, you know, circle something or highlight something. New orders is typically the most important one. The overall is pretty important. But if there's other ones in here that are pretty important, you might highlight them. The most recent report registers 57.6, down from December. For the month of January marks overall 20th consecutive month of growth. So anything over 50 is growth. And then what we like about the PMI is that it's a leading indicator. It's asking people, what do you think the next 6 months? Unlike the unemployment report, which is a lagging indicator, it's telling you what's already happened. It's already done for. The economy could be recovering really strong and you still have bad employment numbers because it takes a while for the numbers. But PMI is looking ahead, so people really like the PMI because it's telling you the next 6 months, the economy is going to continue growing. So that's why it's a good, important number. The continued expansion in manufacturing has been coupled with strong employment situation. Here's another quote. The U.S. manufacturing sector remains in a demand-driven, supply chain constrained environment, but January was the third straight month with indications of improvement in labor resources and supply. Talks about CPI. Inflation talks have dominated this in December. The CPI, which tracked inflation, rose 7% compared to a year earlier. December inflation rate is the fastest U.S. has had in 4 decades. It's going to talk about the Fed. The Federal Reserve was already viewed as having a hawkish approach regarding inflation. What is hawkish versus dovish? The Fed is reducing rates. Are they doves or hawks? They're dove, right? They're being friendly. They're increasing rates. What are they doing? They're hawks, right? Because they're trying to slow the economy down. So doves are nice and friendly and sweet. They cut interest rates. Hawks are predators. They're trying to destroy everything, so they raise interest rates. Willing to increase rates to keep inflation in control. Favors starting the turn to tighter monetary policy with successive rate increases. With the employment situation coming in strong, particularly labor and wages, economists and investors, inflation down the line is imminent. You're seeing a lot of strength in labor. You're seeing really hot inflation with portends. Inflation down the line. This gives the Fed cover to be more aggressive. Yeah, I mean, he's covering all the stuff that's interesting. Probably a 50 base point. Yeah, definitely the market's saying market's gonna. All right, so the only thing I didn't see in there, and he might after class show me, is I couldn't find the previous unemployment rate. Everything else was good. Anybody see any major weaknesses? Like, why didn't we talk about this? It's well written, it's clear, it's understandable, it's giving me information that's pretty insightful. He's not giving me usage information like, you know, employment jobs are up 2,000 for the month. Like, well, who cares? Like 2,000, you know, give me the big stuff. He's talking only important big stuff. This is certainly everybody's worried about, right? So he's covering all the good stuff. I would set up some of these. He has a lot of stuff in here that didn't happen on Friday. And your boss asked about Friday. So just putting that section of, here's a section, I want to discuss in this section, the broader context of this employment report and talk about some numbers that came out before the report. You know, you just set that up so your boss is not confused. But overall, very, very, very strong. Now he's going to talk about the market, stock market indices, at least for stocks, the variety of volatility and catalysts such as inflation, higher COVID. The Standard & Poor's 500 offer for an S&P 500 stock market index concludes. All right, so what about this? You can put that in your paper if you want to. I don't count off. But in real life, your boss, she's head of equities at Fidelity. Would you tell her what the S&P is? Probably not, right? So it depends on your boss. If your boss is, you know, some engineer at Valero, then maybe. But what's the probability your boss, engineer Valero, is asking about the jobs report? Probably not. So I tend to not define the S&P 500. I'm going to assume the person asking for this knows that already, but I don't count off for it. I've had students, you know, we'll see in his paper, actually define what the 10-year treasury is. I'm assuming the person asking for this knows that, all right? So for my paper, for my class, I don't really care. I don't count off for it. But in reality, be careful. If your boss actually doesn't think that they know what the S&P is, they're probably going to kind of be insulted. Like, you know, what, you don't think I know what that is? So I would probably leave that out. Friday's jobs report prompted S&P to fall initially with the assumption the Fed will approach inflation. Share prices recovered at the afternoon. I thought the initial action was strong, but I can't remember, so I have to go back and look. He's using the Bloomberg charts, which is good. I like using Bloomberg charts. They're not real pretty, but everybody knows Bloomberg. So having Bloomberg charts in your paper is actually impressive that you know in Bloomberg and you have it. So that's the reason I like giving you Bloomberg charts. With the market typically unwelcoming of news that could accelerate the pace of action from the Fed, we could see some volatility. That's fine. The only thing is he's changing fonts. So that's probably my excessive compulsive person. That changing fonts kind of bothers me. But other than that, does that bother anybody else? I'm probably the only one in the room. It's like, why did he go from Calibre to whatever? But, okay, we're mixed. All right, so one thing here, let's look at it. Ending the day with a 23-point increase or 0.52% climbing to 4,500. Does that look correct? 23-point increase. Sounds right, right? At the Investment Society, the person presenting there said a 23 basis point increase. Does that sound right? So don't get points and basis points mixed up. It is 23 points, 0.52%. That's right. He could have said 52 basis points, but that would be kind of showing off. And he gave the closing. He does like I do and didn't put a comma. I don't usually put a comma on the S&P 500. I don't know why, but I don't count off. But I'm used to it not being there. But you know, either way. All right. So he's covered the S&P. Didn't really talk about the high and the low for the day. He could have done that, but he kind of talked about the pattern throughout the day, which is good. He's going to talk about, well, he says the sectors were mixed. That's good to say, hey, there was any one particular sector that was really up or really down. That might be interesting. Talk about the NASDAQ. Gave a little bit of history on the NASDAQ, given the tech stocks are selling off. Gave a quote. This job short was affirmation that yes, stocks are going to be jittery and there's going to be a lot of volatility. About one stock in particular, Amazon, Russell 2000. Again, has a definition there. Definition on this Russell 2000 index covering small companies might be the most I would do. I wouldn't give such a detailed definition. And talks about them. 10-year Treasury, 10-year Treasury securities have been viewed as the baseline for bond market for decade because they are backed by US. Again, it's a lot of definition for someone who probably already knows that, but I don't count off for it, but it's fine. On February 14th, the 10-year Treasury vaulted above 1.9, hitting the highest level since December, the leap of 10 basis points. Now, this I would not do. So I just don't like that. I might actually count off a little on that. So I would take that out. I don't like talking about the percentage change in percentage. To me, it's just really, really confusing. He's already got it covered, right? 10 basis points. That tells you everything you need to know. Saying that the yield rose 5.64% to me it's just confusing. I know it's in the paper, they show it on the reports. I don't like, and I don't know anyone in finance that talks like that, but there probably are some in some places. Just where I grew up, we didn't talk about percentage change in a percent. He said a significant price drop. You notice he doesn't say what the price drop was, which you really can't for treasuries, because there is no 10-year Treasury. There's a bunch of them. There's a 10-year Treasury that was a 20-year bond issued 10 years ago. That's kind of a radically different price than a 10-year Treasury, which was a 15-year bond issued 5 years ago. It can be radically different prices because they have different coupons. So we really can't say how much the bond price fell because we don't know which bond we're looking at. And it has a big difference. A high coupon bond is going to have a very different duration than a low coupon bond. So you really don't know. So all you can do is say, put an adjective or an adverb in there, a significant drop. And he's got the picture of that. The strength of economic release has fortified the case for the Fed to be hawkish. The Dow reinforces his case for hikes. I think it's good. He's getting a little bit on the redundant side here at the end. So he might think of cutting. If he's got the same thing in several places, he might think about cutting back. It's getting a little bit, because he's kind of said that already, hasn't he? He's been talking hawkish for a while, so he might. So rather than repeating it here, and you'll certainly see that in discussion below about the 10-year Treasury, and then not repeat it under the 10-year Treasury, something like that. He's going to talk about commodities, gold, and talk about the US dollar. Got more quotes. Talk about oil. Now, what do you do on oil? Oil is a specific grade. WTI did not have a direct response. They're going to release later in the day, news release that rising. So yeah, that's good. He explained that it really wasn't related to the employment report. And then he has a final section. So the key in the final section, I'm looking through all of it, is how good of a job did you do summarizing? So you want to make sure you're not overly redundant and you get right to the point. So to me, just looking at it, looks like it might be a little bit long. So maybe he could cut back some on that. So yeah, I mean, there's some redundancy in here. I might, on the stock side and on the bond side, shorten this and just put it with the stocks and bonds, and then overall. So it's just, it's getting a little bit. This is the first time for him mentioning Ukraine, so that may have something to do. Yeah, from your boss's standpoint, brevity helps a little bit. So at the if you're going to do a final conclusion, well, I would think keep it to what, 2 paragraphs? Keep it pretty short. So I think that might be a little much for my taste, but it kind of depends on your boss. But what do y'all think? If you're the boss reading this, are you getting to the point where it's like, man, can you just give me to the bottom line? In fact, one thing I like is bottom line, 3 bullets. Here's the things, you know, that's what she wants. She's going to go meet with the CEO. Here's the bottom line. So if you can do that, it's a little bit stronger communication piece. Or do you want that kind of, what do y'all think? In the very end, yeah, I agree. I think he's done a great job really hitting important stuff up above. So less is more at the end. That's part of the critical thinking, right? If you can get the very end and say, hey, let me boil it down for you. That's a pretty powerful thing to be able to do. So that would strengthen it. He may be saying some stuff in here that he hasn't said before. I would say move it back up to the other section. And then when you come to the very, very end, go back and look through the whole thing and limit yourself. Say, okay, if I go back to this whole report, what are the 3 things that stand out to me? Not what are the 17 things, but what are the 3 things that really stand out to me? And then you find 5 and you got to kick 2 of them out because you want to keep it right to that point. So that might help there. But overall, very, very strong paper. So if I were to actually grade this, you get 100 there, 100 there, 100 there. Did he talk about private payrolls? I can't remember. Yeah, he's got private payrolls in there, and I give him some credit just because he showed the whole report. Oops. The rate expected, I didn't see prior, it might be in there. He talked about participation rate. He talked about sectors and wages. He did quite a bit there, so I definitely have to give him there. Stocks, he did well. Bonds, given the percentage change in percentage, you know, I might, who knows? I'll be real cruel. Give him 95. Definitely covered other markets. I thought the clarity was very, very good. And critical thinking, I might give him 95 just because I don't know. I could go either way. I could say 95 and 100. I probably would do that. On the clarity, what am I thinking him on clarity? Conclusion is way too long, would be my opinion. Now I could be wrong on that, but when you're taking a college class, guess what you're stuck with? You're stuck with your professor's biases. All right, so tough luck. That's the way life is. So he would have gotten a 96. 96 not bad for a draft for a paper that's not due for 5 more days. So some of you are like, man, I'd take a 96 now, but so he's in good shape. He definitely thought about it. It's well written. Any of y'all be embarrassed to have this on your LinkedIn? You're real proud, right? It's a good paper. So yeah, stop writing college papers for the rest of your life. Never write another college student paper the rest of your life. You're a professional, right? Professional, you're getting paid hundreds of thousands of dollars because you know stuff the average person in the street doesn't know. So, you know, make it look like a professional.
What else could possibly be reading paper?
Well, at USA, we wrote, every week we wrote something on the internet. It wouldn't quite be like this, but we'd certainly be saying this is what happened in unemployment this week in that rural markets. So we wrote ours every Friday. So definitely the Friday that this came out, we'd write it. It'd probably be about 1/5 the length of this because our audience was retail investors. There are certain people who have blogs that write this kind of stuff, and there's certainly articles that come out. This is probably a little lengthy for what your boss would write, but it's fine because he wants to really get into it and really get into the data. But there's people making decisions ultimately. Investors making decisions that they want to see what's going on in the market so they understand. All right, so good first. If someone else wants to share, we got a couple others. If they want to share, we can certainly. I do have some that have offered me up their exam 1, question 1, so I'll wait on that till next week and show you those so we can start getting practice for exam. All right, any other questions on that? Does that encourage you or discourage you?
So earlier, like 2 weeks ago, you said, write them as we would write our own notes. But then you said that you discourage bullet points. I've always written my notes.
Well, I don't want it to look like a homework assignment. I want it to look like a paper that you hand to somebody. It can have bullets in it, but I don't want to just look like an outline. I want it to look like a paper. So I'm discouraging bullets where the whole thing is bullets. So you can say, The three things are, and have that as a bullet list, but don't have bullet three things that are, and then here's the three things, and then the five things, have introductory sentences, have it flow. The main thing is, if I were to hand it to someone who's never taken this class, they should be able to read it and know what's going on. It shouldn't look like an outline to a class. All right, does that make sense? If you're not sure, show it to me and I'll let you know if it's too bulleted. All right. Now, who knows what I'll do when I actually see this paper? Is possibly he ends up with a 93 because I changed my mind on something, but who knows? I'm pretty consistent in my grading. And I grade pretty fast because I have 100 students to grade this weekend with 2 classes. So I'm going to be moving fast. I can only grade about maybe 5 papers an hour. And I have 100 papers, that's 20 hours. So I'm moving pretty fast. So I will give you the details back. So if I didn't miss something, you can come debate with me. Now, of course, if you say I missed something, then I can read it again because I might have missed something else, so say, okay, I gave you 5 points here, but I found something over here that took 10 points off. So, would that be fair? The student wants to debate that I missed something, I can find something I also, no, well, I usually don't do that, but, All right, I think I saw Evander come in, right? All right. We have another employment report coming out, what, in a couple of weeks? So are you more interested in it now than you were before you started this class? Pretty important stuff. Markets, you think Joe Biden's interested in the next employment report? Which one is he most interested in over the next several months? September might be a little late for him. September comes out in October. Elections are in November. With all the absentee voting, well, you probably need a strong August and September report. Probably there are studies out there that look at the impact of and employment's one of the most important ones. A bad employment report can definitely change votes quite dramatically. So yeah, I mean, some of this is pure luck, isn't it? That's kind of the downside of democracy. Some of it's just pure luck. The stock market crashes the week before the election, and people are in a bad mood, and people like the whole world's falling apart, kind of thing. So we'll see. So this one he can recover, but this one's pretty good. He probably likes this one. But if he had gotten a bad one the next couple months, he can probably recover. But as it gets closer to the election. All right, we're going to come back to tactical allocation. I might do some on Wednesday again. And then we'll really practice more for the exam next week. So I want to get to the execution side. And remember on the execution, we had a couple of questions. First, do you do it yourself or hire someone? And then we're going to talk about the active and the passive. If you're going to do it yourself, that's called security selection. You're going to decide which assets you're going to buy. Do I buy Amazon? Do I buy Meta? Do I buy Exxon? That's security selection. You're going to make that choice. Then you'll need a broker. I don't know how many of y'all have a broker. Who in here has the broker in this class? Okay, Michael. Michael's the only one. I'm sure someone else does. One card, so you have one, don't you? No one uses Schwab or have an online trading. Right. If you don't have a broker, go get yourself a broker. You must say, I don't have any money. That doesn't matter. You don't need money. The one my students like, or think or swim, TD America Trade. You can create an account. If you have no money, guess what you do? Play money. Play money. They have a play money account. How much do you put in that? I don't know, 47 million. Why not? Who cares? It's play money. And then just start trading. Why do you need to do that? Well, first of all, if you get into an interview, there's nothing worse than interviewing for a finance job if you've never bought a stock in your entire life. That is just, I know some PhD finance professors that have never bought a stock in their life because they've always been in academia. That seems strange to me as a finance person. Like, how can you be a finance? But they just never needed to. They believed in efficient markets. They put all their money in mutual funds. They're like, why would I ever do that? But if you're going to interview for jobs, you need to buy stocks. Now, if you don't have money, a paper portfolio is going to be good enough because their paper portfolio looks like a real life portfolio. You're getting actual trade dollars that they think you would get, and you get the practice. And then the other reason is you can do whatever you want to. You can sell futures, you can buy options, you can write options, you can buy stocks, you can short stocks. Stuff that can you lose a lot of money. If it's paper money, why do you care? You know, go for it. So get yourself so you're used to doing trades, knowing what a stop order is, knowing what a market order is, limit order. Try them all, do some practicing around. There's some really cool trades we'll talk about with options, using covered calls or even selling puts, where you can kind of execute your idea today without actually having to do the stock. And it's pretty cool. If you want to sell, we're going to talk about with covered calls. Say, hey, I want to sell this stock if it hits 80 bucks. It's at 70 bucks now. Well, my suggestion is go ahead and sell it right now for 80 bucks. Now, how would you do that? We sell a call option with a strike of 80 bucks. We'll talk about why would you do that? Well, if you're going to sell it at 80 bucks, why not get paid $4 for doing it? If it never hits 80 bucks, you make $4. If it hits 80 bucks, you got your 80 bucks and you're happy. You know, we're going to talk about that. Those are the kind of trades you can do on TD Ameritrade. And guess what's going to happen? You're going to lose a lot of money because you're going to make mistakes, but that's the way to do it. That's how you learn. I was listening to the lady today, Samantha, whatever her last name is, starts with an M. She was talking about how horrible 2008 was for them. And she says, yeah, it was horrible. And it's also the best education I've ever had in investing. I learned more about investing in 2008 than I could have learned at any other time. So, you know, that's how you do it. You go out there and try things and see. So I'm not advertising Thinkorswim. I just know I've had students use them and they find it works really well for paper portfolios. Robinhood, obviously, I don't know, does Robinhood have a paper portfolio option? You might know. You know, everybody likes Robinhood because it's free, but now everybody's free, so you don't really need Robinhood anymore. I know the GameStop people don't like them anymore, but so that's the do-it-yourself part. You're gonna have to have a broker. Getting a broker is really simple, especially today. You go out and get a broker, and boy, you know, you just link it up to your checking account. They'll have the money tomorrow, and it's really incredibly easy these days to get money into an account. Or you hire a manager. If you hire a manager, then we're going to talk about mutual funds or exchange traded funds. Yeah, then you have to go find the manager. What's easier, to pick a stock or pick a manager? And I think they're both equally difficult. I don't think either one's all that big. And there's no real data that says whether we're good at one thing versus another. It's like, I'm not good at picking stocks. Well, I'm really good at picking portfolio managers. Well, why? What skill do you have to pick portfolio managers? My risk management class, they get to actually experiment on the portfolio management thing and see how reliable the data is. All right, so we're going to talk about that, each one of these, and then active versus passive. If you're active, you're trying to beat the market, and you can do that in two ways. It's what we were talking about on the tactical is at the asset class level. You think US large cap growth stocks are overvalued, all these tech stocks, and so you're going to underweight those and you're going to buy small cap value stocks. That would be a tactical move where you're trying to win at the asset level. At the security level is, hey, Facebook is sold off 27%. I'm going to put some money in Facebook. I think it's oversold. I think if I'm buying Facebook, I'm going to beat the market. So that would be at the security level. You can do both. You can mix and match. You might say, hey, small companies, I'm going to pick my own securities. Large companies and bonds, I'm going to hire a manager. Or large cap, I'm just going to buy the index. Small cap, I'm going to try to beat the market. Now you could say, I think large cap stocks, that's market is so efficient. There's no way I'm going to beat that. But these really small companies, if I put some time in, I may find some that are just undiscovered. They only have 3 analysts following them. Yeah, people make that argument. Jack Bogle says when you buy the market, it's not about buying the market, it's about saving money. And I'll show you the numbers on that. When you buy the market, the main thing you're doing is you're cutting costs. It's not that the market does better than managers. And in fact, there's a famous article that says that's impossible. It's impossible for the market to beat portfolio managers because when you add up all the portfolio managers, what do you have? You have the market, right? Can the market be different than the market before fees? It's the same thing. Right. So the market and the market are the same. What's the difference between buying the market and hiring someone? Well, the market you get for almost free, and hire someone, you got to pay 100 basis points. So Jack Bogle says, this is not about it's a better strategy. This is about saving money. It's cheaper. You don't spend all that money on managers who, are random. Sometimes they win, sometimes they lose, kind of thing. So we'll get into that as well. Let me start with this. So 447. All right. So they made me head of equities. I was sitting minding my own business, and then suddenly I'm head of equities. It's pretty funny. The guy, I used to work for this guy, and he retired. He was head of equities. I'd already followed him in one job. He quit it. He left another job, and I took his place. And so someone in my staff goes, "Hey, Ron Stewart's retiring. Why don't you take his place?" And the whole room burst out laughing because they know how much I hate stocks and how much I hate mutual funds. They all started laughing. So yeah, all right, I'll do that. Well, a few days later, the guy comes over, "Hey, Ron, you're interested in Stewart's job?" I was like, "Oh, yes, why not?" So I thought, okay, I hate mutual funds, but I'll take this job. I'm gonna give it a shot, but I want to know, how can you tell the good mutual funds from the bad mutual funds? Because I'm not gonna be responsible for mutual funds. I want to know. So I started a study and reading books, and there was 5 things I found that are important. If you're picking mutual funds, there's 5 things that are extremely important. 3 of them I got from Bogle and Montier. I do like Montier's book. They're ones that I kind of believe anyway. And then 2 of them I found myself just by my own analysis and starting this job. So the first one's the easiest one, management fees. Study after study after study says that when it comes to portfolio management, you do not get what you pay for. All right, if you're gonna buy a Ferrari or a Chevrolet, which is the higher value? Which would you pay more for? Is the Ferrari really a better car? Is it really? Are you sure it is a better car? Probably is, right? But what if Fidelity charges 100 basis points and Vanguard charges 4? Does that give you evidence that Fidelity is better? They're more expensive, but are they better? And studies have shown actually the higher the management fee, the worse they perform. Actually, management fees are predictive. They're predictive of performance because higher fees mean worse performance. I don't know what other world that is. If you hired the most expensive plumber in San Antonio, would you get better plumbing services than the cheapest plumber? I don't know. I haven't done that study. But what if you knew the more you pay for a heart surgeon, the more likely are you to die on the operating table? Would that be surprising to you? The less you pay, would you go out and find the cheapest heart surgeon if you knew that? It'd be kind of strange, wouldn't it? But that's the investment world. The more you pay, the more likely you are to do badly. The less you pay, the more likely you are to do well. That's an easy one. Really easy one. So let's do Fidelity. I always do Fidelity Contra Fund. Good fund, interesting fund. First of all, what kind of fund is it? Based on our class notes, large cap growth, we've seen that before. Their expense ratio, say that in basis points. How many basis points is that? 86, right? So management fees we usually say in basis points. 86 basis points. The category average is 99 basis points. This study says, on average, Fidelity will do better than the average fund just because they're 13 basis points cheaper. Pretty simple. Can we get any cheaper? Well, front end loads, 5%. So you give them $100,000, they're going to take $5,000 right from day one. What chance do you have about performing if you start off 5% behind on day one? I remember a guy, one of my friends from high school, he had one of these front end loads. He caught me right when I started my career. They charge a 7% front end load. He said, "Oh, you know how you pay up front and it amortizes over life." And I was like, "No, I don't have no idea what you're talking about." It's like, yeah, but that's the way it works. We get it up front, but then we give you all this work. What he didn't tell me was they charge that 7% up front and they charge 1% a year. So they're charging a high upfront fee and their annual fee is really, really high. He didn't tell me about that good part of what his company does. And then some firms have a deferred sales fee. So when you leave, they're going to penalize you on the way out. I would never buy a mutual fund with front end load. I would never buy a mutual fund with the deferred sales load. That makes no sense to me because they're not doing anything. It's not like, hey, he gave us the $5,000. We can go out and do a lot of extra research we couldn't have done before. That's not what's happening. They're not doing anything that people aren't charging anything are doing. So it doesn't make any sense. Could we get cheaper? Here's a Vanguard fund. What do they charge? Really zero. They say 3, but did they really charge 3? They do securities lending. They probably make 5 basis points on securities lending. You're probably making the market plus 2 bips just because of securities lending. Everybody does securities lending, and you make 3, 4, 5 basis points. So probably you're getting the market for free when you hire Vanguard. 3 basis points. I mean, that's the lowest I ever had. Barclays sold us the fund for 1 basis points. And I may told you before, they came and visited us from UK. And it's like, why did you fly over here? We're paying you almost nothing. You just spent our entire fee by flying over here to visit us. I don't know why you're visiting us.
What do they make money?
They're charging 3 bips because it doesn't cost them much because all they're doing is buying the market. It doesn't cost much. You don't need 50 people to do this. You need a couple of computer programmers, and the computer programmers can run 20 mutual funds. One's large cap, one's small cap, one's growth, one's value. Yeah, you don't need a lot of people to do this. Yeah, it's cheap. $3. It helps to have $8 trillion in assets. 3 bips. Would you take 3 bips on $8 trillion in assets? That would buy you a nice little house, right? So it helps that they're so massive and they can charge very, very little. But yeah, it's a very inexpensive fund. So yeah, Jack Bogle says it's all about fees. That's the most important thing. You should pay as little in fees as you can because that's your money. The next one is turnover. And what's been discovered is firms with high turnover, they churn their bit and they're buying stocks, selling stocks, buying stocks. They don't hold them very long. Those managers underperform managers who hold their stocks for a long time. So again, the lady today, I really recommend, it was Masters in Business, Samantha something, if I could remember her last name. She's taking Bill Miller's place. So this is obviously a very impressive person because Bill Miller is like one of the gurus of our business. She was very, very impressive. But she talked about turnover and how their goal is to hold their stocks for 3 to 5 years. Very, very low turnover. That's their goal. But firms that churn their business a lot, they tend to, part of it is that it's expensive. Every time you trade a stock, you're losing money on that because of the bid-ask spread. And some of it is just bad behavior, which comes to number 3. Now, turnover, you can look at turnover rates. So here's the turnover for this fund, 4%. Now, I don't know what the category average means here. That doesn't make sense to me. 5,000%. I don't even know what that is. They buy and sell every stock several times a day. That doesn't make sense to me. But if you go back and look at Fidelity, is that Fidelity? Where's the turnover? Fidelity, where it is, 32%. So, I hold it average stock maybe for 3 years. That seems reasonable. This is a very good mutual fund. They've done well historically. I had a mutual fund I ran that I hated. Oh, I hated this fund. I think our turnover was like 150% or something. It was just ridiculous. And that was the way it was designed. And my boss said, your name better be listed in the prospectus as being one of the investors in this fund because no one's going to buy your fund if you're not one of the investors. And I said, how much do I have to invest? So we'll put something in. So I stuck 10,000 in and said, okay, I put money in my own fund. Does that make you happy? I hated the fund, but I had a massively high turnover ratio. So you could just compare that. So the fees are high, but lower than average. The turnover is probably lower than others. We don't have other funds out there to compare it to, but it's probably lower. 32% is probably pretty reasonable, but not nearly as low as Vanguard. Why? Because Vanguard's buying the market. They have no reason to sell a stock. The only reason they'd sell a stock in the S&P 500 if a stock leaves the S&P 500 and a new one takes its place. That's the only reason they would have to sell a stock. So that very, very low turnover. What does this do for your taxes? What happens every time a manager sells a stock? Creates a capital gain. That's going to be taxed. So it's bad tax. You know, it's going to be bad for your taxes as well. And these studies weren't even looking at the tax side. They're just saying, just the pure returns before taxes, high turnover rate managers do worse than low turnover rate managers. This next one, and the podcast I listened to today, she was talking about this, gains versus losses. The biggest mistake retail investors make is they buy a stock, and if it goes up a little bit, they sell it so they can brag to their neighbors about the 10% gain they made. If it falls 10%, they say, hey, if it gets back to my buy price, I'm selling it. It falls 20%. Hey, when it gets, I bought it at 80. I bought it at 100. It's at 80. When it gets back to 100, I'm going to sell it. It falls to 70. When it gets back to 100, I'm selling this thing. Falls to 40. When it gets back to 100, I'm going to sell it. Instead, on the gain side, they buy it at 100, goes to 110, they sell it. They go brag their, yeah, I bought it at 100, just sell it for 110. Did that in 2 weeks. What a genius I am. Do you have any other stocks in your portfolio? Oh, I can't remember any others. There was another one I bought for 100. I don't remember where it is right now. Yeah, it's pretty amazing. There's a study that found retail investors in the 90s, when the stock market did nothing but go up 10% a year, the majority of retail investors actually lost money in the 90s. How do you lose money when the market's going up 10%? Because we're such horrible traders, because we sell the winners way too fast and we cling on to the losers with both hands, and then it finally falls down to $10. You're like, I give up. You sell, and then it rallies back up to 100. Well, we discovered that this isn't just retail investors. Professional investors do the exact same thing. And studies have shown, if you look at the ratio between gains and losses, if that's balanced, those funds do really, really well. If it's skewed, such that their gains are like 10% gains and their losses are like 30, 40% losses, and those managers really underperform. Why? Because of ego. They don't want to sell their losses, because once you sell your losses, you're admitting that you're wrong. It's much better to say, hey, we were early, the stock's coming back, we weren't wrong. Your ego likes that a lot better. We love selling gains because then we lock it in and we know we're right. We don't have to worry about the stock's up 20%, it might fall 40. Let's sell it so we can get that in our egos. So I can't show you where to get this number because it's not an easy number to get. But if you could get this number, it would be a really good indication of which managers to hire and which managers to avoid. You don't want a manager that's out there making decisions not to make you money, but making decisions to make them feel better about their decisions. All right, those are the three you see in these books. The ones I add: reversion to the mean. Reversion to the mean, what that says is funds that have recently, like the last 2 or 3 years, have done really, really well, are much more likely to underperform than firms that have recently done poorly. Part of that's just a normal cycle. Those funds that have done really well the last 3 years had what? Apple, Facebook, all those high tech stocks. Is that where you wanted to be January this year? Probably not. These cycles run around. So you may be hiring managers not because they're really good. You may be hiring managers, they just have to be in the right place at the right time. And so you're hiring them. So you're almost better off betting on the funds. So when we interview managers, we actually didn't look at their performance. We said, we don't want to see the performance. You come in and tell us what you do. And then after we listen to them, we say, boy, with that strategy, 2016 should have been a really horrible year for me. You must have really underperformed in 2016. And we look at the performance and actually outperformed in 2016 and say, okay, are you actually doing what you just told us, or what's going on here? How did you outperform in 2016? And you discover what they told you is all marketing hype. They don't actually do that. That's not good. All right, you say, hey, I like your philosophy. We have that same philosophy, and boy, 2016 was a horrible year. Yeah, it was a horrible year for us. And we're like, good. It should have been a horrible year. We agree with what you're doing. Markets do stupid things. I'm glad you didn't follow the market and you stuck to your beliefs. So that was our philosophy. Because these things do run in cycles, and it's just, I had a boss who asked me, said, I don't need a number one manager. Just give me someone who's consistently in the top 25%. I'll be happy. So I went out and looked at every manager, several thousand managers, and I wanted to see how many of them are consistently top 25. And I found 11. I said, here, boss, here's the 11 managers that are consistently in the top 25. And I said, oh, by the way, if I just did this based on random chance, I would have expected to have found 13. Right? Top 25%. What's your chances of being top 25% 3 years in a row? Well, 0.25 times 0.25 times 0.5. Well, I should have found, if it was random chance, I should have found 13 managers. I found 11. So what does that tell you about those 11? Good chance it was pure luck. Had nothing to do with skills. It could have been skill. I remember I was presenting one fund manager, and they had a great run. And I say to the committee, yeah, man, they've done great. I'm glad we had them. We don't know if it's luck or skill in this market. And the guy head of investments said, you don't have numbers like that if it's not skill. I go, okay, fine, whatever. My future boss, I better be nice. That manager blew up the next year. It was horrible. So was that manager really skilled and just unlucky, or really lucky and then the lack of skill was, who knows? I mentioned Bill Miller. Bill Miller is famous for beating the S&P. I mean, it's really amazing. He beat the S&P 15 years in a row. That is unheard of. He is a value manager. So he beat the in 1999. How would a value manager do in 1999? Anybody remember? Y'all weren't alive then, but if you ask your parents about 1999, what was going on then? .com. Can a value manager do well in .com? He did. He beat the market. And then in 2000, guess what he did? He said, man, these tech stocks are overvalued. He got out of them, moved to value. Pretty amazing, isn't it? How did he do after the 15 years that he beat the market? He had 3 horrible years. Now he's back and he's doing great. I think he's actually quite skilled. I do recommend not the Bill Miller that does barbecue, but the other Bill Miller, just like Mason. He's great on podcasts. You can probably find him on YouTube. He's a really good speaker, really smart guy. I do recommend listening to him. And you go 15 years to beat the market and not have some skill. I think, yeah, he probably has. I'm pretty sure he has skill. I think I would say that. But what happened in the 3 years he underperformed? He made a mistake. I think he bet on energy, and energy just didn't work. He made a bet and he was wrong. Does that make him an idiot or stupid or unskilled? No, you're going to be wrong in this business. Any business that relies on you to predict the future, you're eventually going to be wrong. So reversion to the mean is going to happen. For him, it took 15 years, but reversion to the mean happens. Now, one thing you have to be careful of on reversion to the mean is there's another force in finance that is also really powerful and goes the other direction. That's called momentum. So you have momentum that says what? Stocks that are going up keep going up. Stocks that are going down tend to keep going down. That's momentum. Reversion to mean says stocks that have underperformed are likely to outperform. Those that outperform likely to underperform. They're both correct. It's all about timing. So momentum goes on for a while, and then reversion to mean kicks it back down. What's the hardest thing of all? Figuring out that timing. Is it, there's a lot of people calling the great crash of 2008, but they were calling it in 2006. And guess what happened to them? They look like idiots. They moved too early. They were really smart, but they're 2 years early. If you're really smart in finance and 2 years early, guess what? You're unsuccessful. And what do we do about the people who are right in 2008? We make movies about them. Does that mean they were smarter than the people in 2006? They were definitely luckier, but smarter, who knows? We'll never know, because luck has a big role to play here. And then the last thing I discovered, which to me was pretty obvious, obviously important, is, we may have talked about this earlier, but there was one group of funds that was always number one, time after time after time. And it's Vanguard. Why is Vanguard always the number one family? Number 3, 4, and 5, USA kind of moved around, and Fidelity moved around, and we're all kind of fighting over second, third, fourth, fifth, sixth, seventh place. And then Vanguard is always number one. So my first thought is, well, they do index funds, and they're really cheap on index funds. So they're number one in index funds. So I told Michael, the guy, my analyst, hey, do Vanguard, but take all the index funds out. Just look at the non-index funds. So guess who was number one then? Vanguard. So I was going, okay, what does Vanguard do that these other firms don't do? And there's one thing that stuck out so obviously. Vanguard does not replace managers after a 2-3 year bad period of performance. They just stick with them. The longevity of Vanguard's portfolio managers was radically different than all other funds. I mean, radically different. There was no comparison. Vanguard hires smart people, asks them to manage money, and then lets them do their job. And if they have a few years of bad performance, they're like, yeah, everybody does, of course. You didn't suddenly become stupid. You're still smart people. You have good people working for you. Obviously, a value strategy is not going to work well when growth is taking off. You're sticking to what you're doing. It makes a lot of sense. Yeah, you're ranked bottom 20%. And they just stuck with them. Other managers could not do that. And that's why Jack Bogle gets back to, we're no longer an investment profession. We're a marketing profession. And that's why I hate mutual funds. Mutual funds are not about investing. They're about marketing. What do? You push your best funds and you shut down your worst funds. And Vanguard says, no, we're investors. We're hiring people to invest. They're going to invest. Sometimes they're going to win. Sometimes they're going to lose. We're going to stick with them. And because process trumps performance, because so much performance is just random noise, just pure luck. And the industry knows that, but industry doesn't care. Industry's focused on how do they sell stuff. You don't sell a bad 3-year history. You don't tell people, hey, they've underperformed last 3 years, but reversion to mean, they're going to come back, they're really smart. You don't sell that. You sell the manager that's done well the last 3 years. So this is the nature of the business. We figured this out early when I came over. And so I told the board that, I told my boss that. They're like, yeah, that's so true. Patience, you just got to stick with them. And oh, by the way, Ron, when are you going to fire MFS? Because they had a really bad quarter last quarter. And it's like, okay, I don't think you're listening to me. We didn't fire MFS and they had their best year ever. And it's just like, so why? Because we're so focused on marketing.
For the turnover ratio, does that apply to short positions too, or just all?
Well, short positions, you don't see those in mutual funds. So I doubt that's even covered in here. Hedge funds and those kind of places. Short positions, you can't really control your timing because if they want their stock back, you got to give it back to them. So there's a little tougher. I've had short positions for months. You're trying to do short positions for years. It just gets tricky. I mean, there are some stocks, you obviously could do that longer because there's so much. You could probably short Apple stock for quite a while because there's, every broker's got a bunch of Apple stock. And that's where securities lending comes in. That's where Vanguard makes money on securities lending because they lend out their stocks. But it's a little tougher because, we shorted a tip once and we really liked it. We thought it could be a really good play, but like within weeks, the broker said, we want our tips back. So, and we said, well, do you have any others? No, we don't have any others. So it's like, we had no choice. We had to close that down. You go long, you don't have that problem. All right, so I believe in this stuff here, but it does mean you got to be patient. You got to be long-term focused. You're going to have periods of time where you're going to underperform and you just say, hey, that's the way the world is. You pick smart people to manage your money. Of these 5, the first one's easy. The second one's easy. The fourth one's easy. The third one and fifth one are a little more difficult to get that kind of data because you may have a manager that just changed just because they retired or something. But you can look at the overall. It takes some time to sit down and say, okay, what's the average tenure of their managers? That could take you quite a while to figure that out. That could, who knows? With Fidelity, with 500 mutual funds, trying to get that data is pretty tough. So it took us a long time get this data. And 3, I don't even know how you would calculate 3. But the other 2, management fees, turnover, and reversions, I mean, those are all pretty easy numbers to get. And our preference was, you know, we had fund families come in and they would push these 10 funds. And we'll go, well, why aren't you talking about your other funds? Well, they've had a bad run. And we're like, well, those are the ones we want to talk about. Those ones we're interested in. Don't tell us the ones that have recently done well because they're about to blow up. Tell us the ones. So anyway, any other questions on this? What do retail investors do? They buy the ones that done recent. They buy performance. They buy recent performance too, very recent performance, and it just never works. All right, so we'll get into security selection. This 33 Act, we'll talk the 33 Act, 34 Act. All right, thanks.